Hello, YouTubers, friends, compatriots. Look, your shills, dustly, search and vassals. I'm a useful idiot, and today I want to talk about the big lie about QE, or quantitative easing, the Federal Reserve's program of buying treasuries and mortgage-backed securities. And this has been going on for 5 years now, and it's pretty easy to look around and see that the desired results have not happened according to the supposed Federal Reserve mandate. And so these 3 studies that just came out, which I'm going to talk about, don't really tell us anything new if we've been paying attention, but it just kind of spells it out a little bit more. So we can actually say that officially we know that QE has failed, and that's why it will continue. But I also have to clarify that what constitutes a success for this Federal Reserve program and what constitutes failure is also a question we have to ask, because it depends on what their actual intentions are, not what their stated intentions are. So anyway, let's get to this. Let's get to these 3 studies I want to talk about. We have 3 different studies that have independently concluded that the Federal Reserve's QE programs have all failed. These are all the what they call large-scale asset purchase programs. And as it turns out, and this ties in with my last video on the big lie about GDP, is that GDP has been, in reality, flat or in contraction. And these 3 studies also spell that out. So let's get down to brass tacks here and look at these 3 studies. First one's by Robert E. Hall, and he is a member of the NBER Cycle Dating Committee. And he concluded that, quote, an expansion of reserves contracts the economy, unquote, and that, quote, a rise in stock prices generated by excess reserves may sap rather than supply funds for economic growth, unquote. So let's look at what he said there. So an expansion of reserves contracts the economy. So in other words, the Federal Reserve's efforts at quantitative easing have not gone in the right direction. They're actually going in the opposite direction. So instead of expanding the economy, it's actually making the economy shrink. And that's borne out by the manipulated GDP numbers. And then also we see this huge rise in stock prices. And that's because all this money is being sapped out of the real economy by these Federal Reserve moves is being put into speculation and put into the market. So there's no funds left for economic growth. It's not getting loaned out. It's not creating jobs. It's going for economic speculation and gambling on the market. And that's why we're rapidly approaching 16,000. And this entire artificial so-called recovery, masking a depression, is sustained a little bit longer. So the second report is from Hyun Song Shin, a monetary theorist at Princeton. And he said that, quote, lending to non-corporate businesses which rely on banks has been essentially stagnant, unquote. So in other words, major corporations, of course, are getting lots of whatever kind of loans and money they need. All the big banks are, certainly. And but all the small business lending has essentially been stagnant. And that's a couple things. There's small businesses are not hiring, and they're not expanding, so they don't require the loans. And then the other part of the small business sector just cannot get the loans because they're not readily available. And it's interesting because, of course, the jobs, all of our political leaders always say in their speeches that 65% of new jobs are created by small businesses, and yet they are not expanding and creating jobs right now, and they're not getting loans. So in other words, once again, the Federal Reserve is not fulfilling its mandate, and the QE, quantitative easing, is not doing anything to create new jobs, which is supposedly what this is all about. And not only that, once again, we have a confirmation that the banking sector is too large and too leveraged, as always. Then we have study number 3 done by the partnership of Arvind Krishnamurthy and Annette Vissing-Jorgensen. One at Northwestern University and the other one at University of California. They said that, quote, critical that there is no policy, rule, or strategy for asset purchases or an exit from the program. So in other words, as we know, there's no particular strategy. It's just to buy as many of them as useful as they can, and what they can get away with to sustain the fact that nobody else is buying treasuries and nobody else wants these mortgage-backed securities. And they don't have a plan for an exit, as we've known all along. That's why they keep talking about tapering, and tapering's not going to happen. There's no exit from this program. And Yellen's making that clear that she will continue that policy. And then Krishnamurthy and Jorgensen go on to say, quote, without such a framework, investors do not know the conditions under which asset buys will occur or be unwound. So, unquote. And so we have a situation where it's going to create a lot of uncertainty and a lot of volatility. But the volatility is good because that's what the big players make all their money on, up and down movements. But for true investors, it's going to be a wild ride. At some point, it will have to end. It will either end by some sort of wind down, which seems unlikely, or it will be a forced wind down by a catastrophic event. And that final study goes on to say that, quote, there are vague goals towards the labor market, unquote. And that just verifies it's in the other reports. There's no real way that they can create jobs. That's supposedly their mandate, but the government can't create jobs. The Federal Reserve can't create jobs. The banks don't create jobs. Small businesses with bank loans. And if we don't have a situation where the banks and the labor can get together and small businesses get together to create unemployment, create the conditions for more growth, which seems also unlikely. It seems like this cycle of QE will continue. And so the basic bottom line here is that the Fed's relentless buying of mortgage-backed securities has produced no positive economic developments, but has significant negative and unintended consequences. And that's what we will continue to see. And to give you an idea of why the Federal Reserve QE programs not work is because with all this money being produced, there's only two choices. There's no profit potential in the traditional commercial bank operations. So that's not an option. So the banks go and gamble at the international casinos. So speculation. But there's no benefit for the real economy in speculation. That's the only thing driving the market right now. And the Federal Reserve is facilitating this and colluding in this, not working on the real economy. To give you an idea how much money I'm talking about, 81% of the money created by QE is parked in reserves, and the rest is on balance sheets at banks. So let me make that clear. 80% of all the money created by QE for the last 5 years is parked at the Federal Reserve. So the Federal Reserve buys all this material from the banks. The banks take the money that they get from the Federal Reserve for buying that crap, and then the banks just put the money back into the Federal Reserve and hold it there in reserves because it's the only place where they could make money on that. And then they take the other 20%, which is on their balance sheets, and they go out and speculate in the market, of course leveraging it tens of times, if not hundreds and thousands of times. And this 80% of the money that's parked at the Federal Reserve is $2.1 trillion of all the major banks parking their reserves at the Federal Reserve. And they get interest on that. I think it's about 0.25%. But it adds up to about $10 billion a year. So that's another way that the banks have continued to get bailed out, and that's what QE is all about, bailing out the banks. Not only they are the only ones buying Treasury and keeping the government and the economy afloat, but they're buying the mortgage-backed securities to keep all the banks afloat. And then on top of that, the banks get to split $10 billion every year for the last 5 years in free money. And near 50% of these reserves are also from foreign banks. So we have 50% domestic banks and 50% foreign banks that are on a continuous bailout program with the Federal Reserve through QE. Because they get that money and they park at the Federal Reserve and get interest, including foreign banks. And this whole system, like I pointed out, is a transfer of wealth. And it also increases the wealth disparity because of this transfer of wealth. And it's all done from taking everything out of the productive part of society into the financial region and sector where it's not part of the real economy as we know it. And the limited audit of the Fed in 2010 revealed that of the $1.25 trillion of mortgage-backed securities the Federal Reserve has purchased, $442 $1.7 billion, or 35%, were bought from foreign banks. So there's another example. Not only are foreign banks parking their reserves at the Federal Reserve, but and getting interest, but the mortgage-backed securities, $442 billion, 35% of all the mortgage-backed securities that the Federal Reserve has been buying are foreign banks. So the Federal Reserve continues to bail out foreign banks, both through QE, both through paying interest on the reserves, and then this mortgage-backed security buying program, asset purchase, which is QE. So $1.5 trillion mortgage-backed securities. So it also begs the question if the banks are basically selling the Federal Reserve all these mortgage-backed securities right now, and this QE right now is $85 billion a month after month. So if there's 1.25 trillion of mortgage-backed securities purchased, and they keep producing more, so that's something to bear in mind too. The only entity that's buying U.S. Treasuries and mortgage-backed securities right now is the Federal Reserve, and the banks are creating more asset-backed securities and mortgage-backed securities. So the bailouts continue. And then, interestingly enough, during this period too, along with QE, 100% of the loans made by the New York Fed are to foreign banks. So once again, I'm sure everyone out there that's hearing this is just as disgusted as I am about this. And the other thing to keep in mind, to keep this in context, is that the excess reserves of the nation's private banks had previously stayed at nearly zero since 1959. So for the last 50 years, all these big banks didn't keep any reserves at the Federal Reserve, and when they did, initially they weren't paying interest on it. They could just park them there and not get interest. But that's all changed, and the Fed paid no interest on excess reserves until October 2008. Now they get about 10, 12 billion a year, and the Fed gives reserves at near 0%, and then pays out 0.25%, as I said. And let's see, I actually have a figure here. In 2009, banks paid 2.18% interest on reserves. So anyway, there's some staggering figures, some staggering facts. The Fed is suppressing lending and inflation when it states its goal is the opposite. So that gets back to the heart of what I was talking about earlier. We have to figure out what is the Fed's stated goal, what its real goal is. And its stated goal, like I say, is supposedly to encourage lending and increase inflation and deal with the debt that way. And what it's really doing is basically bailing out the banks, reinflating asset bubbles, because that's their biggest fear is deflation. The market should be really taking things to their natural prices, and they're going to fight that, because that's the only thing sustaining all of this entire system, and especially the banks, is the reinflated asset bubbles. And so that's what QE is doing. It's pumping up the market, and the other reason they want to pump up the market is because for most of the mass amount of public, they focus in on the stock market number, and so for them, when they hear that the Dow is almost 16,000, that's the measurement, that's the yardstick for them that the economy is doing really well, because they don't really know anything about what's going on with the economy, and that's why it's really important. But it's also really important because it's a huge transfer of wealth, and they will all cash in, and when there is a correction, they'll all cash in on that as well. So there we have it. Janet Yellen is being in hearings right now. She will be undoubtedly will probably be the next Federal Reserve head. She served under Bernanke. She will continue Bernanke's policies, and QE will continue. She's almost said as much. In fact, it will probably increase at some point. But I can't imagine that it will end anytime soon. And in fact, it may end up being like Japan, where QE can never end. And it's unfortunate because, as I just pointed out, QE is a big lie. I'm a useful idiot. Don't you be one too.